eBay is up over 6% today. The momentum seems to be changing. Is now the time to be taking a position in eBay for both growth and income. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And I'm very happy to present eBay today. Now, eBay has historically been a growth stock, and we're going to be talking about that here a little bit. But in recent years, the company started paying a dividend, and so far their dividend record has been excellent and growing. But I think the main point that I want to discuss today when we look at eBay is the valuation. There's reasons why the stock is low and has gotten cheap, and I'm going to go over those reasons. Some of them were the fault of the company. Some of them were the result of an overzealous market prior to the company seeing a little bit of flattening in their earnings. But now the company's in transition. They've recently laid off some people. Their earnings report came out, pleasantly surprising analysts in most areas. They outperformed or exceeded both guidance and estimates in most cases and most metrics. So let's go ahead and go into FastGraphs, the Fundamentals Analyzer software tool, and take a look at eBay. Now what I've got on the graph here, I'm going to take price off the graph. These are the earnings per share. This orange line is the fair value reference line. This is the fair value that eBay ought to be trading at. And I want you to note that that company had very strong growth, going back to the beginning of 2004 through 2014. Then they had a sag in earnings in 2016. But since 2016, they've had very strong earnings growth. There was a flattening of earnings in 2022 and 2023, although they were still higher earnings than any previous year, the two highest years they've historically had in terms of earnings, reported earnings. The growth had slowed down dramatically. Okay, and that had an impact on their stock price. So let's bring in weekly closing stock prices here. And I want you to note that eBay, there was a time when the market was really valuing eBay at a very high multiple, 36 times earnings in January. And of course, that led to a collapse in the price. And then we came into the Great Recession of 2008 and 2009. And like most companies, we saw a reset there. We saw PE ratios, going from trading around 11, almost 12 times earnings, and they fell all the way down to 3.5 times earnings before they began rising again in future years. And then, the PE ratio got up to about 14 times earnings. Even though the earnings had collapsed, the stock price continued to rise. But I do want you to notice when I put the normal PE ratio on the graph that the normal PE ratio has changed. So if I run this as a 9-year graph, one of the beauties of FastGraphs is the dynamic nature of utilizing this tool. It has a 12.21% growth rate over this period of time. But if I drop this down to a 9-year chart, coming from 2018, 19, 20, 21, 22, 23, we see that growth has now averaged 11.78%. And what we see is a kind of very interesting point of their valuation. Number one is they came into 2018 with a very high valuation. It reverted to the mean, and the PE got down to below 13, which the blue line on this graph represents a PE ratio of 13. That is a PE ratio that basically at 13.28, that has been the norm over this period of time. But the norm is really simply a blended or trimmed average of some high PE ratios mixed in with some low PE ratios. I want you to understand that. The number itself doesn't mean anything. We've drawn a fair value reference line on the graph, which is the orange line. That's the fair value that a company growing at 11.78% with 50% debt and a BBB plus rating and over a 2% dividend yield ought to be trading at. A 15 multiple is not unheard of. You can see back in 2022 they traded at over a 15 multiple. The multiple got up to 18.5. Then it came back down into a 15-ish multiple. Then it got really a high multiple. The multiple expanded to over 20 times earnings, in 2021, by October 22nd. But then what happened is we came into 2022, we had a flattening of earnings. As you can see, earnings growth went from 402 to 411. That was only a 2% growth rate. And then for 2023, the recent year we just seen reported, earnings grew by only 3% to 424. But I do want you to notice something about the dividends. I'm going to put the dividends on the graph now. The company started paying a dividend in the beginning of 2019, and they paid 56 cents a share. Then the dividend was increased to 64, then to 72, then to 88, then to $1, and then to $1.08. Even through these flat years, they still increased their dividend rather nicely. And then, estimates are for $1.08 this year and $1.10 next year and $1.16 the following year. So the company has a good dividend record, but another beauty of fast graphs is I can just point to one of the dots here on the white dividend line and see that the dividend payout ratios only, around 18 or 20%. So we still have a lot. This green shaded area represents all the company's earnings. Okay, and we still have a very low payout ratio. All right, now, but here's the point I want to get at. The stock was very overvalued coming into 2021. They had a flattening of the year. They only had 2% growth, but the stock price fell dramatically from peak to valley at over 54%. Now, it went from being overvalued, went down to fair value, went right through fair value, and now fell to being undervalued. And with earnings being flat quarter by quarter, the company has really stagnated, if you will, over the last couple of years. There hasn't been much in the way of growth. In fact, there's been a little bit of shrinkage just going from September 2022 to February 2024. We've had 0.7% total annual rate of return. We had negative growth, but we did have some dividend income, which, got us to just about a break-even point. Of course, if I bought this at the bottom valuation, which was a PE of 9, the current PE is blended PE is 10.31, earnings yield almost 9.7%. Now we get a 15% annualized rate of return over those 2 years. And now we get a 15% annualized rate of return over these 2 years. And the moral of the story is valuation matters, and it matters a lot. So here's the point I want to make for you. What we're looking at here is a company that has got very good earnings results. Even though the earnings flattened a little bit, they didn't drop, and they were still very, very profitable. But the stock price overreacted and got really cheap there. Now, as a value investor, the key is that you want to buy a good company, a great company, at an attractive valuation. It reminds me of, Charlie Munger, rest his souls. And, one of the things that he taught Warren Buffett, and, Charlie and Warren are considered two of the greatest investors that ever lived. What Charlie, Buffett learned about value investing from Ben Graham, and they called it cigarette butt investing, and, buying stocks for below their intrinsic value. But Charlie Munger added the notion that you want to buy great companies or really good businesses at very low valuations, companies that were growing, and you could buy them at low valuations, and you positioned yourself, very, very well. So let's go back into the fast graph here for a moment, and let's look at where the company sits now in a valuation point of view. If the stock traded at a 13 PE, by the end of December of this past year, it would have been worth about $56 a share. Based on expectations for 10% earnings growth this year, earnings of $4 expected to grow to $4.65 from $4.24, that would put the value at a low PE of 13 at $62 a share, and at a more normal or more what I would call fair value PE, which does have a margin of safety built in, you're looking at almost a $70 stock. Now, the rate of return shooting out to next year would be about 51% from these levels on the normal PE or the low conservative case. And we did a more aggressive case at a 15 PE. So if we got PE expansion from 10 to 15, that would be almost a 50% expansion. This could possibly give you a 74% annualized rate of return. Now, the longer this goes on, the more likely I think it is to happen. Now, people are starting to get more sanguine about eBay right now. I want to go into the forecasting calculator a moment, and I want to talk about what forecasting is all about. What we have on eBay is a relatively well-followed company. I want you to notice there are 23 analysts that were following the company in 2023 and 2024. There are 20 analysts still giving a recommendation for 2025, and then it drops down to 9. But the real key here is what has been the thrust of the analyst estimates for this, growth stock that's now a dividend-paying stock with a 2.25% dividend yield. Okay, so the first thing I want you to notice is these valuation quarters. These are different PE ratios. And the beauty of FastGraph is we can calculate potential rates of return and do what we call what-if scenarios. So assuming that the company does earn 465. Now, 6 months ago, they were expecting it to earn 456. 3 months ago, earnings dropped to 447. And then the last estimate was 446, but now the current estimate is 465. What has happened here is that eBay laid off some people, all right, and that was a constructive step according to most analysts. And it's a turnaround narrative. So, Morningstar claims that, the company has gained steam with the constructive outlook. And then we're going to talk about the fact that, the company made these painful but necessary layoffs, and that should help improve 2024 margins as demand recovery remains sluggish, but due to advertising, it's actually improving quite a bit. Ergo, the analysts thinking it's going to be a 9.67% growth this year, followed by almost 8% next year, and followed by another 8.5% the following year. All right, so if they were to achieve this 8.65% average growth rate, and we went to a normal multiple, the normal multiple for the last 5 years has been about 12.5. That would give us an 18% annualized rate of return. And where that return would come from, it would come from growth of 8.65%. It would come from a dividend of 2.25% that's been increasing, a dividend of 2.25% that's been increasing every year. And then, of course, PE ratio expansion from a PE of 10 up to a PE of 12.45. Now, if it got up to, closer to a 15 PE, which would be a fair value valuation for a company growing at 8.6%, we've gone now to the normal estimate here. A 15 PE would give us a 26% annualized rate of return. Once again, 8.65% growth plus 2.25% dividend that's growing slightly every year, plus the PE expanding from 10.31 up to 15. That's how that rate of return would work. Now, if we maintain the 10.3 PE, I can go to 10.5 here. If the PE didn't expand and it stayed at a 10 multiple and the company achieved, these earnings achievements that the analysts are expecting now, we'd still have an opportunity to make double-digit returns of over 11%. So even without the PE expansion, we would get the 8.65% growth plus the dividend yield plus the dividend increasing. The key is I want you to know not just why the estimates are of these rates of return potential, but how they are calculated and how they are figured. All right, so, the whole key is here, eBay has been a growth stock, and now it's become a dividend growth stock. And I think that's very important. As a value investor, we want to buy the company at a discount to its fair value, which is the orange line on these fast graphs. But more importantly, if we can get a bigger margin of safety, and by the way, the 15 PE ratio already has a margin of safety built in. That would be theoretically, a fair value for a company growing at that level. If we can buy it at a much lower PE like it's currently trading at, as I showed you on the estimate calculations here a minute ago, that gives you a much better opportunity to make money and what's really a very high quality company, BBB plus rated with moderate amount of debt. All right, so, with this company looks very, very attractive. So let's go back to the fast graph now, and let's look at the analyst scorecard. I think it's very important. Now, again, I want to remind you, analyst estimates have been rising. They went down from the 6 months ago to the 3 months ago for 2025, then went down again recently, but now they've increased up to 5. So after the layoffs and the turnover and the latest report, but the analysts have been very, very accurate. In a 1 year forward with a 10% margin of error, this company has hit estimates 83% of the time, beat them 8% of the time, and only missed 8% of the time. And of course, one of the misses was in 2022, which is when their earnings kind of turned flat. With a 20% margin error on a 2-year forward estimate, the analysts still have a very good track record. So we're talking about estimates approximately 1 year out, and we're talking about estimates approximately 2 years out. So this company looks, like these estimates are very, very achievable going, for the company. Now, I want to go back to the historical graph for a moment, and I want to remind you that the company started paying a dividend back in 2019. Now, I want to go through performance. Now, before I go there, note that the stock was overvalued here, and it's undervalued now, all right? So if I go into performance with FastGraph's new performance graph here, this is for the last 9 years, The earnings growth rate has been 13.26%, but the capital appreciation, the compound annual growth rate of the stock price, has only been 2.43%. The stock price has underperformed the earnings growth. If you contrast that to the S&P 500, and in contrast, I'm going to take Walmart off the graph here. I have it on here. You can add more than one. If you contrast that to the S&P had a compound annual growth rate of stock price of 10.86%, earnings growth of 8.92. So they grew earnings lower than eBay, but their stock price went up a heck of a lot more. Now, from a valuation point of view, both companies started out overvalued, or both entities. The S&P 500 was overvalued starting at 12/31/2017. It had a PE ratio of 21, and eBay had a PE ratio of 19. Okay, both stocks above the 15 PE ratio threshold that would be considered fair value. Now, as we go down here, eBay now, because of a couple earnings years, now is down to a PE ratio of only 10.31, as I pointed out, where the Standard & Poor's 500 is trading at a PE of 23.67. Now, remember, it's had lower earnings growth, but the stock price has held up a lot better. That's the market. All right, so, eBay has definitely underperformed the stock market under that basis, but the dividend growth rate of eBay has averaged over 15% compared to only the SPY growing at 5%. The key is this is an overvalued entity, the S&P 500. eBay is an undervalued entity. And the key to making money in stocks is to buy low and sell high, okay, obviously. And then, of course, when we stack dividends on top here, this explains the rate of return. Get the growth potential plus the dividend income, which is the green shaded area here, the light green shaded area, plus the PE ratio going from 10.31 up to possibly 13 or 15 in the long run. Now, I want to look at this stock, since it is paying a dividend, through a couple of other metrics before I leave. So the next one I'm going to go to is operating cash flow. What I want to see here is strong operating cash flow. I'm going to take price off the graph, and I'm going to take the normal price to cash flow off the graph. As you can see, the cash flow substantially covers the dividend. The company, in 2023 had $4.55 of cash flow. They only paid a dividend of $1. That turned out to be about a 22% dividend payout ratio. The company's got a lot of room to continue to grow their dividend. If I go ahead and look at free cash flow, which is even more important for dividend-paying companies, I want you to notice I still have very strong free cash flow. This is what's left over after everything it took to run the business. The company's free cash flow is still very, very excellent. Okay, well covering the dividend. The free cash flow dividend payout ratios under 30%, okay, which means, again, they have plenty of free cash flow to covering their dividend. So I feel that the dividend on eBay is very safe. Now, the whole key to this is, you want to buy stocks when they're cheap so that you can sell them when they're more expensive. And, that is really the role of the value investor. The whole idea of a value investor is you exploit the market. The market does not always price stocks at attractive valuations. I believe, based on what analysts expect right now, eBay is trading at a big discount to its fair valuation, especially its future fair valuation if earnings begin to accelerate again, as analysts expect. Now let's go ahead and look at the last presentation that the company did. This was produced on February 27th, 2024. This was their financial highlights for the year. And here's the point. The company's gross merchandise volume was $18.6 billion. The revenue was $2.6 billion. Their non-GAAP operating margin was 26.7%. Their non-GAAP EPS was $1.07 for the quarter, and they had 16 million enthusiastic buyers. But I want to skip through here, and I want to compare that to what the consensus was. Okay, the consensus, the guidance, I said consensus, this is the guidance. The company guided for gross merchandise value of 17.9 to 18 billion, 18.3 billion. It came in at 18.6. Revenue, they guided for 2.4 to 2.5 billion. It came in at 2.56 billion. They expected the operating margin to be 26.1 to 26.7. They ended up on the high side of that, and their non-GAAP earnings per share beat by about 2 cents. Okay, and you could go through this presentation yourself. Point I want to make is that eBay had generated a pretty solid quarter, and that's why the stock today is up. The last I looked, it was up about 6.5%. It's currently up 7.77%. So the market is starting to recognize the value of this company, the fact that the stock price is trading below its intrinsic value. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. I hope you enjoyed this presentation on eBay. eBay looks like the market might be turning around. It's been flatlining for the last couple of years. Generally, it's been at least locked into a trading range. And now perhaps it's beginning to break out, and this might be the right time. But again, as always, I encourage you all to do your own research and due diligence. The company did report earnings just yesterday. Earnings were good. That's why the stock is up today. They weren't great earnings, by the way. But, again, they were within expectations for what was to be a flat year in 2023, but now 2024 is expected to be a better year. And your job as an investor would be to make sure that you're comfortable with the fact that the earnings could grow at a 10 or 11% going forward. If you like the video, give me a like. Ring the bell, subscribe to our channel, and take a look at subscribing to the FastGraph tool. We keep getting better and better, and we've got a lot more great things to come. And I want to thank all of our current subscribers for their support. And I want to encourage all of you that, if you're investing in stocks without FastGraphs, I believe you're investing blindly. Thanks for watching. Talk to you again real soon.